I think more people struggle with the idea of saving and having debt at the same time because I've been there and I've done it. And sometimes your brain is like, well, if I have this debt, then maybe I should take the money that I have saved and pay it off. I made a video not too long ago talking about how I like to see my savings growing. Okay, and the thought of me taking my savings to pay off something or like some debt is like stupid, because what if I need a tire? What if I have an emergency come up and I need to get to that money, or my son needs something for school randomly? Like, I need the money that I have saved because an emergency could happen.
Hey guys, welcome back to the channel. Robert here. She has a very good point, and I think a lot of people feel the same way that she does. Somewhat caught in a conundrum on, should I keep the money that I have in my account or should I pay off debt? And I would say to you this: if you already have the debt, you already have spent the money. What I mean by that is this: the money that you have in your account is really not yours. Example, if you've borrowed $1,000 and you have $1,000 in your account, that $1,000 has already been spent. So the goal is now is to limit the amount of interest that you're paying. What I would advise someone to do in her situation is to pay off that debt. If you are an emotional type person, then you can't look at things analytically. That's not just how you're made up. What I would say is you need to find out budget wise what your actual expenses are. The exercise, look at your bank statements or your credit card statement, whatever you're using to transact, go back 3 months and get a true lay of the land as to what you have coming out monthly, aka a budget. Then you need to have 6 months worth of that. Maybe you start breaking that dollar amount down to the point where you can get to that 6 months, and that's an emergency fund, separate account, strictly for emergencies. You have to separate those things, not commingle, because psychologically you think those monies are yours. And then once you get that 6 months, that's there. Everything else has to go towards getting rid of the money you've already spent, because you're trying to limit the amount of interest that you're paying. Hi, for those of you that don't know me, my name is Robert, and on this channel, we simplify the home loan process. Today, we're going over scenarios that people are playing in their mind that want to become homeowners, but they have barriers like the one we just went over. So stick to the end, because we're going to give some solutions, but also would like to hear from you. A lot of you have a lot of experience, so take a few minutes and share that experience to help somebody that might be having this situation. I thank you in advance. Remember, just do so respectfully.
I'm going to be way more transparent with you guys about my financial goals and what that process looks like in me achieving them. My biggest financial goal at the moment is saving for a down payment on a home, and I live in the Washington, D.C. metro area, and baby, it is not cheap here. This has required a lot of planning on my part, so I want to share with you guys the outline that I have for how I'm going to save up this money. The first thing I really had to do was set out my goals, and for me, the goal is to buy a home in like 22 months with about 80 to 90K available for a down payment. Second step was to create a budget. Now, I've had a budget since I've graduated college, but what I did need to do differently in my budget was prioritize my house savings. So I did this by listing out all of my expenses, all of my bills, taking the amount of money that I know I need to save per month for my house, defining that first, and then anything that's left over, that's what I allocate to all the different sections of my budget. Third thing was to automate my savings. So the amount of money that I need to save each month gets directly taken from my direct deposit, and it gets deposited into my high yield savings account. Fourth step is to reduce debt as much as possible. I finally finished paying off my car loan, so that's taken care of now. And then my goal is to eliminate the rest of my student loan debt, which I have about 5K left of. This fifth step is going to be the hardest for me, but it will be cutting out unnecessary expenses from my budget. It looks different each month, but some months I cut back on dining. Some months I give myself less money for my allowance to spend. It just really depends, and I review it on a monthly basis. Last thing I'm going to be doing is saving any extra income I come across, whether that's from like RSUs vesting from my job, social media income or just like any gift money, anything, it's going straight into my high yield savings account. And that's how I'm going to be saving for this house.
Excellent breakdown here. Unlike the first creator, which I would say is someone that's an emotional type person when it comes to money, I would say this young lady is more analytical. And the reason I'm making that distinction is if you find yourself in one of these two profiles, if you will, that's important with how you handle debt. The first creator, I would say, paying off debt, you're more of a snowball effect person because as you see those winds coming, it gives you the wind that you need to continue and stay the course. This young lady's more analytical and she can look at things a little differently, maybe from an avalanche type process in that, hey, I'm going to take the highest balance or the highest interest rate and knock that off because very detailed in planning. But overall, love what she said about automating as much as you can automate. We're all human. We all have behaviors that we've created, good and bad. And when it comes to money, most of us have bad habits because we deal with things emotionally. Anytime you can separate yourself from the money in a positive manner by way of automating, moreover, putting it in a high yield savings account, something that garners some interest. Love that. And then the last thing that she said, I'll couple it with, or I'll restate it by saying lifestyle creep. Any windfalls, any new monies that come in, we tend to lifestyle creep it away. And you never realize the change that you can make in starting to grow your wealth. A lot of folks that are renting and having to rent today, depending on where you are, rent is going up. And these are the reasons you want to have a plan of action to get onto the property ladder. I have no doubt that she's going to hit her goal and be able to achieve home ownership. Now, some of you might be saying, I don't make that kind of money, or I'm not an analytical type person. I need to figure out a way to be able to have a margin in my money so that I can do all I can do to start saving and get in that direction. Well, one cheat code that a lot of younger folks do not utilize is what this next creator is going to talk about. And if you can do it and do it right, it will really be a game changer for you. Let's check it out.
If you are fortunate enough to live with your parents or have a situation where like a family member is willing to let you stay with them and you don't have to like really pay rent, do it. For the last 10 years of my life, I've been renting and I've moved home like a few times, but this is probably like the most disciplined I've been when I move home, because like I'll move home and I would just like blow money and be out on the weekends all the time, you know, splurging, traveling, just blowing my money and not saving. But this time around, I'm just like in a different stage and phase of my life, and I've actually been saving money for a house. Things are going well. And like on average, I've been able to save like $2,000 a month living with my parents. I just noticed like a big change in my discipline with spending money. Like I used to just splurge and buy stuff and like run up credit cards, and I don't do any of that anymore. The point I'm saying is if you are blessed enough to stay with family members and save your money, like really save your money. Some people take that for granted. I'm about to be in my 30s, so it's like I want to own something.
Shout out to you, young lady. It really is a cheat code if you have parents or a family member that you can live with, if you take advantage of the opportunity. It's akin to what the last creator, young lady, was saying. Any windfalls, any new money that's coming in, if you are going back to live with family and they're carrying most of your living costs, and you take the change, that windfall that you experience, and just waste it off, then it's no different than the opposite, right? Your lifestyle creep is in full effect. It's just in a different manner. Some of us mature at different times, different situations. Don't take this as a knock, but if you find yourself watching this video, it's not a disgrace. It's a blessing if you could go back and have somebody help you. The thing is, take advantage of the opportunity. I think she surprised herself. She was able to save the amount of money that she was able to save. Shout out to you in a short period of time. And that should let you know that you're wasting a lot of money. And here's the deal. I've been a loan officer for 23 years now, and I've seen people have an opportunity when home prices were much less, when they were younger, in their 20s. And they use that time to rationalize, hey, this is not for me, because of the accountability, because of the responsibility that comes with owning something, the maintenance, the upkeep, so on and so forth. Those same people today, either they do not have the opportunity to buy anymore because of their income situation, or they've not built the mental discipline that it takes to invest in something. And it's a muscle, guys. Social media and all this stuff that you see is just speaking to the lust of your flesh, and it's going to constantly have you in a consumption loop. You must, as she said, you must own something, and it takes time. And the way the game is played in these United States, asset prices are typically pegged with inflation. Inflation is everywhere, food inflation, consumption inflation, but once you spend it, you don't have anything to go back to. And so if this message resonates with you, that's who I'm talking to. If you're a proponent of renting, continue to rent. All I would say is this: you need to make sure that whatever you're doing, you're not consuming everything, because prices are going up. It's just a matter of how much and how fast. Nothing is the same price as it was in 2010. And so keep that in mind. You may be in a situation where you have a budget, you're doing all that you can do. You just need a little bit more to get over the hump, to get onto the property ladder. This next creator, I'm going to allow her to plant this seed, and then we're going to wrap this video up. Let's check it out.
I like this because a lot of people do want to own homes, but maybe you are in debt and you don't know which option is best. Now, before I get into the debt payment or the saving, you might not have to save at all, right? Because if you are maybe in like the median income, and even if you're not, even if you're like a high income earner, there are down payment assistance programs. I know two people who have gotten $20,000 and $30,000 in assistance this year, right? So it's still going on now. So in that case, you may not have to worry about saving your money or trying to pay down your debt, because those are grants. So you don't have to pay that money back and get it popping, get your house. It would depend on how much debt you have though, because if you have a little bit too much debt, you might not qualify for a loan. In order to get an FHA loan, you have to have a debt to income ratio of 43%. So to figure that out, you would take all your monthly debt payments and you would divide that by your monthly income. If you get paid bi-weekly, then you'd want to take your annual income and divide that by 12. When you're calculating your debt piece, make sure you add in what you want your mortgage to be, right? So if your debt is like $500 and what you want to pay in your mortgage is $1,000, then your total debt is going to be $1,500. If that amount is over 43%, then it makes more sense to pay down your debt, because you're not going to be able to get the house anyway. Mind you, some companies are even more strict than that. So I've been working with companies that have a more like in the 30s range, right? Of how high they'll let you go into debt.
Overall, I like the message. The message that I wanted to convey is this: you may need some help with down payment. I'm assuming you have some money saved. I'm not talking about buying a home and not having any reserves. That is a recipe for a disaster. Grants are not prevalent. They're not just out here for everybody to have. Number one. Number two, grants are going to be for those of you that are at the very bottom of the income threshold for whatever program. Number two, the homes that you're buying aren't going to be in the price range that a lot of you all want to buy in. I want to make that distinction because online, folks don't go in detail. Second thing, with most down payment assistance, we dealt with grants. Most are what we call silent seconds or graduated forgiveness. The key with that is this: you have to know how long you have to stay in the house for the down payment to be forgiven over time. A lot of states want you to be there for 10 years. Now, getting into that might sound great, but what if we're in a declining rate environment and you want to refinance? Depending on the lock-in period on that down payment assistance, you're going to have to pay that back. Number three, FHA will allow you to go up to a 55.6% back-end ratio. I don't agree with that. I like what she's saying with the 43%, but we just want to be correct. And my point in that is this: a lot of folks chat GPT and pull stuff up online and you get the wrong information. So technically you can go up to 55.6%. In some cases, it might make sense. It's a case by case. For the majority, the lower the debt to income ratio, the better. I actually like 43% because inflation and things are higher. Used to be 31 to 33%, but things were a lot cheaper back then. And so the key to that is this. We as lenders are going to qualify you on your gross income if you're a W-2 employee. You live on the net. So this is why you have to know your numbers. I want you to have money after closing. 3 months of house payments minimum. 6 is better. The more, the better. And so if you plan properly to get into a home, it will be a blessing to you. Now, it's very important who you partner with. Okay. Now, as I stated before, I'm a lender. My NMLS license number is 180100, National Mortgage Licensing Systems. You can put that in and check me out. A lot of people think I'm fake. I'm real. And if you choose to do a home consultation, I'm the one you're talking to. You're talking to Rob. Hit the link in the pinned comment or in the description if you're ready. And let's have a conversation to see if there's a fit. If you haven't, take a few seconds, hit the like, subscribe, and notification button. 4% of you guys watch the videos, but you're not subscribed. It helps the channel, and I thank you in advance. So my time is up. I thank you for yours. Look, guys, as I say to everyone, let's be good to one another. Let grace abound. Watch these next 2 videos here. They'll help you on your journey as you're educating yourself to get onto the property ladder. And until the next time, indeed, y'all stay blessed.